Hello, good morning, everybody, and welcome to Gulf Intelligence Daily Energy Markets live video podcast for Thursday, April the 28th. I'm Frank Kane, standing in again for Sean Evers. Brent crude at around $103 this morning, stuck in the hundreds, 110 range where it's been virtually all month. Some talk, as in the News Digest, of oil losing its upward momentum. European gas prices, on the other hand, soaring, and much more to follow on that. Meanwhile, the language from Ukraine and Russia and from the West, it seems to me, is all about escalation, attacks, threats, even of nuclear weapons being used. And noticeably this week, the past 2 weeks, Ukrainians seem to be able to attack some pretty vital energy and infrastructure assets inside Russia, almost at will. So I would like to go first to Mark Oswald, Chief Economist and Global Strategist for ADM Investor Services International, who has just returned from Poland, which is really at the moment the cockpit of Europe, because as I'm sure we've all read and as is on the News Digest, Russia has stopped supplying gas to Poland and Bulgaria. But Mark, tell us what's the news from the country, how's the feeling, and how will they replace Russian gas in the short, medium, and long-term timeframes?
Well, the feeling in the country is, in Poland, there's always been a fear of Russia. They've always despaired of the fact that the rest of Western Europe seem to be too complacent about Russia. And they're now in the process of saying, we told you so. Why didn't you see this coming? You've been basically cozying up to Putin for far too long. And they feel, in a certain sense, vindicated, though in the worst possible way. As for the block on gas exports from Russia, it doesn't really make that much difference in Poland. It's sort of, we've turned this whole thing on its head, because the EU was basically pressuring Poland for a very, very long time to to start getting rid of its dependency for electricity generation from coal. Now that's proving to be a blessing in disguise. There was a very good reason why Poland didn't want to do that, because they went through such a lot of mass unemployment during the 90s. And when people started to pressure them to start closing some of the coal mines, they said, well, we can't go through another bout in another sector of mass unemployment. And I wouldn't say that was wisdom, was foresight, but with hindsight, it's proved to be a huge blessing in disguise. It's the block on for Bulgaria is likely to be have a much bigger impact, but obviously in relative terms,
a much smaller economy terms, yeah.
Poland's obviously that much more important.
Yeah. How will they replace it, Mark? I was reading about pipelines being built from the Baltic, to ship it in. How will they do it?
Well, they'll probably have to. They've already been doing a lot of, because they've distrusted Russia for so long, they've been looking for alternative sourcing. So they've been sourcing oil from Iran, they've been sourcing gas from Qatar, and obviously there is Norway as ever. But my question would be, is everyone seems to want to rely on Norway to replace Russian gas, and at the moment, particularly from what we know about upstream oil and gas investment over the last 5 to 7 years, I'm not really quite sure where all that supply is going to come from, and there's going to be a lot of diversion needed.
Let's go to Dr. Carol Knackley, CEO of Crystal Energy. Dr. Carol, hello. You are an expert on many things, I know, but you're also something of a German expert. And Russia has doubled its revenue from oil and gas sales. I read in this morning's Guardian, since the invasion of Ukraine, it has doubled revenue as volumes have gone down, but values have gone up. I guess that the elephant in the room is Germany, the biggest importer of Russian gas in Europe. So Tell me, if you can, what the feeling in Germany is. I see that Deutsche Bank reported its best financials in almost a decade, but warned of the threat of recession in the German economy from Ukraine. The Germans are vacillating between help and support to Ukraine, but also fear of damage to their own economy. Which way will they fall, do you think?
Good morning, Frank. Good morning, everyone. Well, look, I'm everything but not an expert on Germany. It's too complicated for me. I've been staying there for a while, and there are lots of facets that I'm still trying to get my head around. But I can easily see that people are nervous. The government, from various statements, they are taking what happened yesterday pretty seriously. Because let's put the numbers into context. Yes, I mean, for Russia, may have been perhaps easier to cut its supplies to Poland and Bulgaria, though they haven't cut, because these countries are also transit countries. So the transit gas flow is still ongoing. But Bulgaria, they got last year, I think, 1.5 BCM, Poland, maybe around 5 BCM, billion cubic meters. Germany, in contrast, is around 28 or 29 BCM. So it's really a giant. And of course, they rely, I mean, it's also, we shouldn't forget, it is the largest economy in the Eurozone. And if we take the German perspective, if Russia cuts its gas supplies, at the moment, there are no immediately available alternative. I mean, Poland held on tight to its coal, quite rightly so. When you look at the situation today, leaving aside the climate perspective, Germany had coal, but they were moving away from coal in the name of climate.
Can they revive that, Carol?
Well, I don't know how easy it is, but don't forget, they are quite anti, there's a strong anti-coal sentiment. So I'm not quite sure whether the energy security concern will take over the climate security issue in Germany, especially with the Greens in power. So I'm not quite sure. But what I saw there, people are taking some serious steps. They are really turning the heating off just because they want to save on their energy bills, and also to take position against Russia. But that takes me to another point. While at the moment things look quite dire, at least from the German perspective, because they don't have readily available alternative, I think if Russia, because you mentioned in your opening remark, Frank, how much revenues, oil and gas revenues, Russia is getting. So imagine if they lose their biggest gas importer in Europe, what that means for their oil and gas revenues or gas revenues. So there's also the additional dimension that would be felt in the longer term, that is Russia losing its prime position in the European market. And it's going to happen maybe later, but it would be simply accelerating the trend.
Right. The FT had a nice phrase for it this morning, that, you know, the kind of Mexican standoff between Germany and Russia, they called it MAD, mutually assured deterioration, I believe was the
That's
phrase.
a nice
yeah. So it is some kind of Mexican standoff, isn't it? Let me move to Edward Bell, Senior Director of Market Economics for Emirates NBD Bank here in the UAE. Ed, hello. I want to get some sense from you, if you can, of the ruble factor here, because of course the ruble is not a very important global currency. But the question of rubleization seems to have become a big factor in energy thinking since the invasion of Ukraine. Several energy traders are going along with the idea of opening ruble accounts at Gazprom Bank to allow energy trade to continue. Is this real? Is it Putin politics? What's your sense?
Yeah, well, good morning. It does look like a little bit of a workaround. As long as the direct export of natural gas, of oil to the EU countries is not sanctioned, then this does look like the kind of fudge that is available to carve that out as a sort of critical sector to allow payments from countries, say like Germany or Austria, for instance, to keep importing Russian gas. So the money gets deposited into a euro account at Gazprom Bank and then gets converted internally into a ruble account. There has been, I think, some more politicking or some more standoffish noise from those countries that are far less dependent on flows of Russian natural gas, say France or Spain. They can afford to take a bit more of a harder line against Russia, given that they really do not rely on it in their energy mix to the same degree that many of the economies in Central or Eastern Europe do. But it is a sort of workaround that would allow for the flows to continue until we get some official sanctioning of the entirety of Russian commodity trade for European Union importers.
Okay, and is that likely to happen? I sense there is resistance in some countries in Europe to that, Germany in particular, as we mentioned.
Yeah, that does seem to be the stumbling block for now. I think, again, it depends on how reliant those economies have been on the flow of natural gas, the flow of oil from Russia. I think we have seen some initial signs that maybe you're not going to see an official complete embargo in terms of blocking Russian oil imports or Russian natural gas imports, but that EU countries or EU importers would have to pay a higher tariff. So it's trying to dissuade importers in other ways, just making it that much more expensive to do those trades. I think, the issue around it's a little bit different, I think, the EU perspective than it is, say, importers in Asia, where we've seen some auctions of Russian crude oil fail because basically that oil needs to get out onto a ship. Ships need to be insured, cargoes need to be insured, and anything there is coming up against the sort of US sanctions on the financial system. Whereas with the pipeline infrastructure effectively locking Russia and the EU importers together, you can not have those same kind of worries that you would have to, say, underwrite a cargo on a ship.
Okay, let's stay with the currency theme, can we? Because another big factor in rising commodity prices is the strength of the US dollar. We're approaching a 2-year high against the euro and sterling, yen too. And this seems mainly to do with the prospects for higher interest rates in the US, doesn't it? Mark, give me your take, please, if you would, on the effect of currencies within commodity rising prices at the moment.
Yeah, I mean, a lot of the time commodity markets say, oh, we're down because the dollar's up. I think at the moment, really, a lot of the time that is because no one's got anything else to talk about. But at the moment, we are absolutely at the critical juncture in terms of how currency volatility is going to impact commodities, and only things like diesel, for instance, which is up into the sky now, is really immune to it because of supply factors. But put this in perspective. The yen hit a 20-year low against the dollar, or i.e. the dollar hit a 20-year high today after the Bank of Japan basically doubled down on its loose monetary policy. And it is this prospective divergence in interest rates, which is driving a lot of this. And it's going to carry on until we get to the point, particularly in terms of the yen, where we suddenly start to look at, well, actually the BOJ, the ECB are suddenly going to throw in the towel and say, actually, we do need to move on rates. And that creates the opposite flow, and that will start to see the dollar give back. I think the real problem at the moment is the underlying volatility that we've got in every single type of asset class means that there is less and less protection in financial markets. And so that when we get, I wouldn't necessarily call it shock news, because a lot of the time you should be able to see some of the things that we're having coming. There is simply no protection in the market. There's just a massive downdraft because it's so expensive to hedge against the volatility. Options premiums are up in the sky, in wherever you look, really, and that in itself means that volatility becomes self-feeding, and that's probably the most dangerous thing of all.
Dr. Carroll, let me get your view on this. I'm sure you did. Did you see the cover story on the Economist last week, the Fed that failed, which was a kind of sustained attack on Fed policy with regard to interest rates, which I guess is the main reason why the dollar is rising. It said that there was a hair-raising loss of control at the Fed over inflation prospects in particular. So give me your take. How did the Fed get it so wrong, do you think?
Well, look, I don't think it's about getting it wrong or right, because we have to take into consideration that we've been in uncharted territories now for a while. It started with the pandemic, the COVID-19 pandemic, and we saw unprecedented, monetary easing in major countries everywhere around the world, but particularly in the US. And then when things started to look a little bit better, we got this war in Ukraine, was really, I don't think anyone expected, at least last year. So in that respect, if I put everything into perspective, I'm not quite sure who could have got it right. I'm sure maybe if the Fed may have accelerated its easing, its tightening last year, and things would have gone in the wrong direction or worsened still, people would have said, oh, you were too soon in what you did. So that's why I don't have strong views in terms of whether the Fed is getting it right or wrong. Of course, there are serious concerns about it may be too late to tame this ravaging inflation in the US, but it's not only in the US, it's in other major economies. Look at the Europe, for example, the Eurozone or elsewhere. But I think it's a question of time. And maybe if we talk about this next year, then maybe we'll have a better, we'll be in a better position to say whether the Fed got it right or wrong. But really, we have to remember, we've been in uncharted territory on many fronts, and the war in Ukraine and the upward pressure on prices, commodity prices, food prices, energy prices, with their detrimental impact on many economies around the world, should be taken into consideration in terms of affecting the way forward.
Okay. Ed, I don't know how many elephants we can get into a room, but it seems to me that the other one has to be China, where there is now a severe threat to Chinese economic prospects because of the zero COVID policy. We are seeing lockdowns threatened on the strength of very small numbers of infections by Western standards, and indeed by the same kind of standards here in the Middle East. So, give me your view on that. Is this policy threatening global economic recovery?
I think, yeah, very, very critically. And it's been, was a driver between the growth forecast downgrades that we had from both the IMF and the World Bank in the last 2 weeks. And that you have, this enormous economy that is maintaining still very restrictive controls related to COVID-19 and curbing domestic demand, but then also creating these enormous problems across supply chains to the rest of the world. So I think, many of us probably would have seen the kind of charts of vessels docked outside of ports of Shanghai with these enormous backlogs for any kind of, not just commodities, but any kind of product manufactured in China that'd be going somewhere else. So I think it is quite a serious risk in terms of headline growth numbers, that you have a sustained slowdown in China's economic activity. We've had a little bit, I think, of misleading information or numbers where we had Q1 data for China's GDP coming in a little bit stronger than the market had been expecting, which didn't really seem to gel with the kind of real, more near-term data that we saw for March, which showed quite a marked deceleration in activity, things like the PMI numbers dropping quite markedly. So if we get more of that kind of information feeding in through the next couple of data prints, I think it'll be much more evident how slow China's economy is operating. It's also worth noting that, compared with most developed or big economies, China is really the only one that is still adding stimulus to its economy. So the PBOC maintaining still a very accommodative stance, and we've heard announcements in the last couple of days about greater infrastructure investment. So kind of your bare bones or your meat and potatoes kind of investment that has helped support Chinese growth in the past. And that's marked very, I think, very divergent with what we're seeing in the US, which is much more drawing back on monetary policy, even on fiscal policy, in the same way in the Eurozone as well.
Let me stay with you, Ed, because there seems to be a growing feeling that the Gulf, where I am, where you are, is something of an exception to this global trend. Markets are soaring, economies are booming, the IPOs are falling out of the trees. Just give me your longer term view on this. Is there any threat to this? Are there any clouds on this horizon?
Well, I think it's certainly in the nearest term, let's say the next 12 to 18 month period, I think conditions look quite promising for the Gulf economies, particularly for Saudi Arabia and the UAE. Oil prices are high, so we're expecting budget surpluses in the order of about 10% in both countries this year. So there's a very marked big oil windfall. And you also have oil production increasing in that environment. So that really helps your fiscal and your external accounts. At the same time, the non-oil economies, they endured very difficult conditions during the pandemic time, but are coming out in fairly okay shape. So we're expecting sort of non-oil GDP growth in the UAE at around 4.5%. So reasonably strong by all standards. But I think if we stretch the outlook a little bit further down, there are some bumps and there are some hurdles that are going to be coming into the UAE and the broader GCC economies. One is that we had looked like a relative outlier in terms of the global inflation story, and that inflation was quite low in this part of the world. In fact, it was basically at 0% in the UAE last year. Now with very high retail petrol prices, notwithstanding what people might have to pay in the UK or across the rest of the EU, petrol prices have come up quite markedly here in the UAE, but also the cost of imported food is going up that much more. And the Middle East and Gulf countries in particular are really quite exposed to the trade from the kind of traditional Black Sea exporters, Russia and Ukraine. The UAE, for instance, relies about 60% of their wheat imports come from those two countries. So with the disruption to supply, elevated wholesale prices, we are going to see a path through of higher commodity price inflation here, particularly for food and other kind of basic expenditures.
Right, let's, can we get the question up, please? The question for today, because this is trying to pull together the two big themes, the two big elephants that we've been talking about. So here is the question. It's a straightforward agree or disagree. The growing prospect of an economic slowdown, even a recession in some places, is a bigger factor in determining the future path of global energy markets than the war in Ukraine. So either agree or disagree, please. Mark, what do you think of that?
I think it's a very tricky question because the whole thing with the inflation that we've got and what central banks are looking to do, it has a lot of, central banks basically use interest rates to curb demand. They can't do anything about supply side problems, and part of the problem with energy markets is a supply side problem. Whether it's over-reliance on Russia, whether it's the lack of upstream investment in the oil and gas sector. So it's complex, but I think, yes, on balance, I would say yes, it will have. I think we're already seeing, when you look around, particularly at the consumer level, but I think also at the business level, quite a lot of demand destruction actually happening. And demand destruction is happening from the inflation rather than interest rates, because actually, what we've had in terms of interest rate moves so far is minimal. What we're doing is obviously anticipating a lot. I would stress, obviously, the minimal interest rate moves only applies to Europe, UK, Japan, and North America. Other parts of the world, even parts of Central and Eastern Europe, you've had already interest rate rises of 400 or 450 basis points or more. So it is already having an impact there. But I think this demand destruction issue and the fact that we've also at the same time, and I think this is a much under discussed risk, we've got hoarding going on because of all the supply disruption and supply displacement. And that really puts us in a nasty place. If you look at the American Logistics Managers Index from last month, basically they say, the index itself was at a high, but then in the subtext, it's basically saying we haven't got any warehouse capacity anymore because everything's absolutely chock full, which basically says everyone's got too much in the way of inventory. And so it does look, as I thought already about 18 months ago, like we're heading for a very old-fashioned inventory type recession.
Dr. Carroll, let's look at the supply side, can we? Because next week we have an OPEC plus meeting. The path seems pretty straightforward, doesn't it? But there are all sorts of rumblings coming from Washington about a renewed attempt at NOPEC legislation. The idea that OPEC and OPEC plus indeed is an illegal cartel. But just give me your broader thoughts, if you would, on what the OPEC Plus meeting will come out with next week. What should they do? What will they do?
Well, I'll answer your question, but let me first comment very quickly on the survey question, because although I said I agree, because the fear of recession is getting stronger and stronger, but it all depends also on what happens with the war in Ukraine. And people are starting to talk about potential for nuclear usage by Russia, and that by itself, frightened the hell out of me when I think about what could happen next. So. Yeah. I said agree on the condition that people are still a little bit sensible, but who knows how bad the situation can get in Ukraine. Regarding OPEC, and this I'm going to relate it to the question of the survey on the fear of a recession. So if they did not react when prices touched almost $140 earlier this year. And I don't think they, even with the OPEC bill, because the OPEC bill is not something new, it's been around for a while. And every time it reaches a stage of getting the president's signature, irrespective whether it's a Republican or a Democrat, it doesn't get endorsed by the president. It's being used more as like a card to threaten OPEC that they want to take a serious measure against. But so far, it never really made it to the last stage, irrespective of who's in power in the US. But
you don't think, though, that relations have deteriorated so much between President Biden in particular and Saudi Arabia that now it is a realistic prospect that something like this might pass?
Look, everything is possible these days, right? But they would be burning whatever, the kind of relationship they might still have with the likes of Saudi Arabia. So this is really like the nuclear option, I would say, in terms of relations between the US and the GCC countries, because not just about Saudi Arabia, you have the UAE, you have Kuwait, you have other countries involved within OPEC, so a much bigger group than just Saudi Arabia. And this takes me to the other point, just related to the survey question, that if you have this giant fear or this ghost of the recession, fear of recession hitting, that by itself will negatively impact energy markets and would exercise some downward pressure on price. And OPEC would say, why do we have to take any drastic measure beyond what we are doing? So this is, in a nutshell, I'm not expecting any changes in OPEC's decision for next month. But again, nobody knows how the situation will unfold. Every day we wake up and we are hit by a new drastic measure. But at the moment, as things stand, I think OPEC will not be, its decision will not be affected by the OPEC bill discussion in the US, not for now, at least.
Okay, Ed, what do you think? What will OPEC Plus do next week? Will they stick with it?
Yeah, I think their commentary has been very clear that they are strictly focused on oil market fundamentals as they picture it. And I think they might come back to anybody asking for higher production, say oil prices have fallen $40 a barrel in the last 2.5 weeks. So there you go. You've just got a big discount in terms of what they could have been. Now, a lot of that is probably related to the kind of demand interruption that we're seeing caused by China. But I think it's worth bearing in mind also that Russia still remains part of OPEC Plus. We have seen more bilateral communication between Russia and its partners across the GCC, the big economies here, in terms of cooperating on what they describe as oil market stability, and any effort among OPEC producers that have a little bit more wiggle room to increase production at a faster pace, say Saudi Arabia or the UAE or Kuwait, that I think would be met with very little interest on the part of Russia, as it would be coming effectively at their own market share. We saw news out this morning or last night from the Russian finance minister that he estimates that Russian oil production will fall by about 17% this year. And I think anybody taking advantage of that would really threaten the integrity of the OPEC Plus alliance and the kind of work that it has done to, from the perspective of the OPEC Plus economies, restore oil markets to sort of optimal conditions for them.
Sure. Although some people are beginning to think that Russia is a kind of lame duck within OPEC Plus. They can't do anything. They are now a destabilizing factor within it. But let's see where that plays out. Can we get the response to the survey question, please? So 67% of people think that economic slowdown is a bigger factor, but I guess I should have put in the caveat that Dr. Carroll very wisely inserted, which is it all depends what happens in Ukraine and where that goes. Mark, just give me some closing thoughts, if you would, on where you think it will go for the next week or so.
I think we're obviously gradually focusing in on the Fed. I don't really think actually the Fed's the most relevant thing that you, but what our problem at the moment fundamentally is the central banks forgot that last time around when we had the GFC, it was mostly monetary policy and not much fiscal policy. This time around, they've made the mistake of fueling the fire. But a lot of the problems that we've got at the moment really all have to do with investment in infrastructure around the world. And so the problems that we've got are not going to go away in any hurry. And anyone saying, oh, well, we're going to up our investment in energy security, all of this. Yeah, okay, in 5 years' time, we reap the rewards. So the volatility that we've got, the fear that we've got about recession is just not going to go away. And nothing that happens actually even in the Ukraine war, other than obviously the serious risk of a further escalation, say to nuclear, changes that.
Well, that's a depressing thought in which to leave it, but I think, thank you, Mark. I think that's a wrap. Thank you all, Dr. Carol Nakleb, Mark Oswald and Ed Bell. This part of the world is heading into a long break for Eid. Gulf Intelligence daily video podcast is back again on Sunday, May the 8th. So wishing you all safe travels, those who are traveling, and Eid Mubarak. Thank you all.
Thank you.